What's up, guys? Jordan from PreCon here. Today we are talking about a developer in Toronto massively cutting the prices on their pre-construction condo in order to try to incentivize buyers. So let's get right into it. The development in question is Allure Condos. So let me zoom right in and show you the location here. It's right here at King, and let me just back out a bit. King and Sherbourne, all right? It's a great product, and I'm going to show you the old pricing because the updated prices, the new prices aren't there yet. We'll have that soon. But you can see the old prices here. So it's about $1,675, $1,700 a square foot. So for example, 544 square foot, one bedroom here will set you back $913,000. So what's the price cut, you ask? Well, they're coming off pricing about $200 a square foot. So they're coming down to $1,475 per square foot. Right now sitting at an average of $1,675 a square foot. So about a 12% repricing across the board. And the question that I have, and the question that everybody in the industry of course has, is this going to cut it? Is this going to move the product? And another question I had after that is there even room to go lower than that? And I don't think there is, and I'll show you why in a bit. Now, the project is fantastic. It's from Emblem. They do great stuff. It's in a great location, and it is a beautiful building. It's hard to find comparables in the neighborhood, but there's a couple of recently completed buildings. So I want to show you what existing units that are in 1, 2, and 3-year-old buildings in the neighborhood sell for on the resale market today. So the first unit we're going to look at here is at Young and Rich. It's 896 square feet, and it just sold in December for just over $1 million. So that puts it at just under $1,200 a square foot. All right. Here we've got a 1-in den, 2-bath, no parking, sold for $770,000. So just shy of $1,200 a square foot. Here we go. We got another one. This one sold for $1,300 a square foot. Now, this is a small 1-bedroom without parking, and it sold back in August, right? The market was doing a lot better back in August, so we will kind of ignore that one. Here we got another one, St. Lawrence Condos, $1.42 million for 1,160 square feet. Puts it at $1,225 a foot. Here you got a 1-bed in that same building, $590,000. So again, $1,200 a square foot. So it's roughly safe to say that in the recently completed buildings surrounding Allure, you're looking at about $1,200 a square foot. Okay. Yeah, you got some high flyers here and there, but the resale market in this neighborhood seems to top out at about $1,200 a square foot, right? So even if Allure, you can make the argument, right? It is nicer. It's got better amenities, better finishes, whatever. Regardless, it's safe to say that Allure is at their new discounted prices still about 20% more expensive than comparable resale. And this is something I've alluded to in previous videos. The reality with input cost, construction costs of pre-construction and new condos in Toronto is you just cannot match resale pricing. And that is why volume's so low. So if we look at December for pre-construction sales across the entire GTA, see that there was 154 low-rise units and 400 condos across the entire GTA. Now, the 10-year average puts us at about 1,200 units. So we should have sold 1,200. So we're running at about 30% volume. We're selling, 70% less condos, new condos than we would normally see. And if you look at strong years like 2021 and 2019, we were selling 2,000 units. Now, what's more interesting to me than just the low volume is where these 400 units would have actually been. And my assumption here, and my assumptions are usually pretty good, on this, at least on this kind of thing, is that the majority of these would have been in the 905s. So not downtown core condos, but outside of the core. And the reason for that, there's a couple of reasons for that. The first is that the 905 markets over the past few years have outperformed the downtown Toronto condo market. So if you look at selling prices for Vaughan condos on a per square foot basis versus Toronto from 2017 through 2023, you can see that the Vaughan condos have outpaced it. Now, in areas like Milton and Hamilton, for example, you can still get in to pre-construction for about $1,000 a square foot. Now, if you're buying a 1-bedroom, right, the difference between $1,000 and $1,400 a square foot, you're talking about, a $500,000 unit versus a $700,000 unit, just for example here. Now, the difference on your mortgage on that $200,000 is like $1,300 to $1,400 a month, but the difference in rent you're going to get on those units is only about a $200 spread. So that's why the 905s are so much more attractive, and that's why most pre-construction investors are looking to the 905s right now. However, despite Vaughan and Hamilton and Milton and fill in the blank for your 905 neighborhood outperforming Toronto, neither of them have outperformed the cost of construction or the inflation in the cost of construction. Now, I charted this out because I really wanted to illustrate how crazy things have gotten in the new construction industry. So when you look at Toronto condos, so I've indexed this chart to 2017. So you look at Toronto condos, for example, and you look today versus 2017, you can see prices versus 2017 are up, 25 to 30%. Vaughan condos prices from 2017 to today, they're up about 50%. But construction costs from 2017 to today have virtually doubled. And that increase in construction costs, of course, has a direct correlation to the price of new condos. And that's why you see this widening spread in the price of, existing condos versus new construction condos. Is essentially, it comes down to input costs, inflation over the past few years. And this is something I've alluded to in previous videos, basically saying, you're going to see things like credits on closing, extended deposit structures, cashback offers from developers, all sorts of incentives to try to move units. But what you're not going to see is pre-construction pricing coming in below resale. And the reality is, when they launched at $1,675, I thought to myself, they're kind of hoping for the moon here. I don't see this product moving at those prices. But $1,475 is, it's the lowest possible price they can probably still achieve their profit margin in order to get construction financing. And even at that, they're still 20% above resale. Now, I don't know how well they're going to do, but suffice to say, this is one that the whole industry is going to be watching. I do think they're going to have some success, though, because Q Tower right here sold pretty well at $1,650, $1,700 a square foot. And that was during, that was last year during the current rate environment. So we'll see how they do, but it's one everyone's going to be watching. If we look at 2023 as a whole, we sold 13,383 condo units. Again, the 10-year average is 23,400. So we're about 10,000 units shy of what we would, typically see. And good years for people like me, 32,000 units, 26,000 units. So we're running really low on volume. And essentially this just means that, in 4 or 5 years, when these extra 10,000 units that would have otherwise completed and been added to the housing stock, those units just aren't going to be there, right? So this isn't good for long-term affordability. Hopefully the government steps in and provides developers with more rental incentives so they can convert that, unsold supply they have to rental inventory, because right now it just doesn't pencil as rental inventory, and it also doesn't sell as pre-construction inventory. So something has to be done. Otherwise, those units just aren't going to get built. Now, I want to show you guys something I found very interesting. So Altus released their cost guide, their updated cost guide for 2024. And it's exactly what it sounds like. Just lets you know, what to budget for as a developer. And if you look at condos here, for example, 40 to 60 stories, you can see in the GTA, budgeting for up to $425 a square foot plus $245 a square foot for high quality, which is the reality for all. Like, nobody really builds no frills condos with laminate countertops, right? So you're looking at $735 per buildable foot. You also have to keep in mind, not everything you build can be sold, right? Some of that is amenities, some of that is corridors. Efficiency is usually in the low 80s, meaning 80% of what you build you can sell. But regardless, we'll just say $735 a square foot. Now, you also have to buy the land that you're gonna sell, right? So I pulled these numbers from Bullpen Consulting's recent land insights, and you can look at a couple of recent sales that happened. And we're just interested in the 416 here. So you can see in Summerhill, somebody paid $258 a foot. In St. Jamestown, $200 a foot. And land prices are definitely coming down, so that'll help bring pre-construction prices a little bit lower. I'll show you what I mean by that. So if you look at Creekside, which, full disclosure, is our listing, so I'm a little biased, but Creekside is a prime example of somebody's land cost, that our developer's land cost essentially being zero, right? And so because their land costs are essentially zero, they can price a little bit better than everybody else. And you can see that here. Our average price per square foot at Creekside is $814 a square foot. You see some of these 2 bedrooms are in the $700 per square foot range. Meanwhile, pre-construction in Milton, you probably can't see this. Let me zoom in a bit. Pre-construction in Milton is averaging about $1,000 a square foot. So that difference in land price here is what allowed the developer to price very close to resale. So anyways, you can see in the 416, you're somewhere around the $200 a foot range. And then of course you have to add just your baseline municipal charges, which in Toronto are $125 a square foot for high rise. So you have $735 a foot building, then you have your land, $200 a foot, then you have $125 a square foot in municipal charges. You're already at $1,100 a square foot and you haven't made any profit yet, right? So what I'm getting at essentially here is it's impossible to build condos right now for cheaper than the existing resale condos. You're at $1,100 a square foot before you account for anything. Like, for example, carrying the land for a long period of time if you have to do that for approval. So, for example, just recently did a study on how long it takes to get condo buildings in Toronto approved. And for a 300 to 400 unit building, on average, you're looking at 690 days. So anyways, the long-winded point I'm trying to make here is essentially, the cost to build these condos is higher before you even, if you were a developer and you're a nonprofit and you just make affordable housing, the housing you're going to build today is still more expensive than the existing housing. And by the way, that existing housing generally by most people is considered unaffordable to the vast majority of first-time home buyers. So we're in a very weird place in Toronto where I just don't see a lot of pre-construction being sold this year, even if rates cut, even if sentiment improves. I think you're going to continue to see people's preference in those 905s where rent to price value is a little bit better. So one thing that'll help the pre-construction market inevitably is just sentiment, right? So let's talk about the general resale market, because what I like to tell people is the resale market is the leading indicator. Whatever happens in resale tends to flow into the pre-construction market, 6 weeks later. So if resale really heats up, even with pre-construction prices being high, it's going to benefit the pre-construction market. So Alex recently put out this chart. The blue line is all of the resale listings in the GTA, and the orange line is all of the rental inventory in the GTA. And as you can see, we're a little bit low on listing volume right now. But what a lot of people weren't expecting was the increase in rental inventory, which actually makes sense when you think about it, because all of these people who aren't getting the price that they wanted or aren't able to sell on the resale market, a lot of them are just relisting on the rental market, right? And you can see that in the rental data here in Toronto. This is a site called Door Insight. You can see that here. You can see that rents have started to slip. Now, part of this is seasonality because this is just a cheaper time of year to rent, but it's not all seasonality because that is a lot of rental volume. As a whole, the condo market is currently in balanced market territory. There's a lot of really good deals out there. Like I said, people call me all the time and they ask, should I buy resale or pre-con? And the honest answer is, if you can buy resale and you can close today, why in the world would you buy pre-con? Which pains me to say as somebody who sells pre-con, but genuinely the premium for it these days is just, it's so aggressive, right? And so if you can buy a resale or you can buy a distressed assignment sale, there's just so much more value in it for you as the buyer. Now, the market has sort of woken up in January, right? I know we're really busy, which is not a sort of a start to the year that I expected, but I don't think it'll last. But I think it's just the rate pauses and the stability that provides. I mean, you look at the market and you go, it's been, 18 months of pretty low volume. And so people have to make moves. People have to do things. And at least the pauses provide a little bit of stability. As unaffordable as everything is at current rates, it provides a little bit of stability that people know, hey, I don't know when cuts are coming. Maybe it'll be, mid this year, maybe it'll be late this year. But regardless, at least this provides me a little bit of stability and an entry point into the market. Now, the reason that I think the first quarter probably won't look so good in terms of numbers, I could be totally wrong. Like, I would love to be wrong on this one. But the reason I think that is because last year ended incredibly weak. Okay. I highly recommend you go watch Vast City Estates on YouTube. He's a buddy of mine and criminally underfollowed on YouTube, but he did a video on this explaining the seasonal price changes in the GTA based on historical norms versus last year. So the light black line is historically what we normally see in terms of price appreciation over the year. And then the dark dotted line is what we actually saw for last year. So you can see that when rates paused last year, we saw the market vastly outperform what we would normally see from a seasonality perspective. And then we saw the opposite as soon as rate hikes resumed. So the year ended incredibly weak in terms of price appreciation, as you would expect. And back to pre-con here. I know there's not a lot of structure to my videos. We should just call this video series ADHD and charts because we jump back and forth so much. But I hope this is valuable to you guys. All right. This is a chart of the average pre-construction pricing for condos in the GTA on a per square foot basis and the average size of unit. The light blue line is the price per square foot. And you can see that here's the market peak and then price per square foot slid a little bit, right? But not much, like 5%. And you would expect a lot more of a decline if you thought that developers have a lot of profit margin, and so there's room to bring those prices down. But what you're seeing is essentially there's not. You're going to see more repricings, especially if what Allure is doing works for them. You're going to see more repricing, but it's going to be on the products that we're already pricing for optimal best case scenario, peak market sort of launch pricing, right? But you're not going to see pricing come below resale unless input costs were to make some dramatic change overnight, which is just something I have no idea how that would even happen, save for maybe municipal charges being adjusted, which again is just not something I see happening as the city is starved for revenue. And again, this is across the GTA. So the average pre-construction pricing across the GTA is $13.48 a foot. And part of this would be that in the last year, a lot of developers who have downtown product and 905 product sitting in the pipeline, they're just launching their 905 product and sitting on their 416 product because there's just not a buyer pool for it. And I want to end this video on a positive note because I know I've been very pessimistic about the pre-construction market. Don't get me wrong, I love pre-construction, okay? It's in my brand name, right? But I do think it's important to note that more lingering inventory in the pre-construction market, I generally view as a good thing. So this is the amount of unsold pre-construction inventory in the GTA over time. You have the red line is combined single family and condos. We're going to focus on condos, the orange line here. So we currently have 17,000 unsold units across the GTA. This is not unprecedented. Sure, it's unprecedented for the last 5, 6, 7 years, but if you go 2016 and prior, it was the norm. These eras here of pre-construction sales were by far the most painful eras of my career, right? These were the times when a new project would launch with 400 units and you would get 2,000 or 3,000 buyers, 2,000 or 3,000 worksheets, bank drafts in hand, begging for units. Don't get me wrong, it is a very profitable time to be in the industry during that time, but it is not enjoyable for me, and it's certainly not enjoyable for the consumer. Because what happens is you have no negotiation power and you have FOMO like crazy. People are just throwing in worksheets, bank drafts because their cousins are, and somebody made a bunch of money on an assignment flip and all this horse shit, right? Like the honest truth is my favorite time selling pre-construction was 2016 and prior, and this little window of time here where we had a lot of lingering inventory, had a lot of optionality. And the reason for that is when there's thousands of buyers, right? When projects oversubscribe in a weekend, I'm sure it's great business as a developer and as a broker. Again, don't get me wrong, right? It can be very profitable, but there's no optionality and there's no negotiation power. So developers don't want to make floor plan modifications during your 10-day cooling period. They don't want to extend. They don't want your lawyer to make any changes. But during this period, and certainly during this period, there was optionality. So instead of sending in a worksheet and a bank draft and hoping you get what you want, you would go to 2 or 3 different sales offices. You would cross-shop floor plans and incentives and figure out which project worked best for you. You had time to make your decision. And you weren't just like aping into things because you were afraid of not getting something, right? And so from a consumer standpoint, like that's a better sales process. From my standpoint, that's a better sale. It's a more enjoyable experience to actually give people a bunch of different options and help them sort through the mess, right? And also, I mean, it's worth noting prices were better back then. So I think, healthy is somewhere between where we are today and where we were a couple of years ago when everything was oversubscribing. The ideal situation, at least to me, is when projects take a year or 2 to sell out. Now, obviously, the flip side is when inventory is rapidly climbing in the pre-construction industry, that means that stuff isn't getting built, right? It's sitting, waiting for sales targets to be hit in order to break ground. And so that starves housing supply. So in the long run, that's also a negative thing for consumers. But regardless, my point is just this isn't unprecedented for this much inventory to be on the market. And I think in general, it is a good thing. That's all I got for this video, guys. I will see you guys next time.